plus imbalance plus liquidity. Always pretty straightforward in theory, but now we're about to take it to the next level. All right, so now that we've reviewed that, inducement type 3, remember this is our lower time frame false BOS within our main range. Draw it one more time just so we can understand, and then we are done going through the inducement type 3. Then our main range, it tells us this is our inducement. Our inducement, again, this can a type 3, right? This type 3, this can be on the 4-hour within maybe a weekly. This could be a 1 minute within a 5 minute. The time frame is irrelevant. It's just talking internal to some form of main leg. So it's that false BOS that's going to trick everyone thinking, oh, now this is going to be a pullback on this leg, but then it's actually going to do what? Make the main mitigation and then fail all the way lower, right? Do traders believe a new trend is forming on the lower time frame? It is our lower high and higher low internal BOS. Internal BOS to go higher. Not that, then the inverse. Internal false BOS. And then, of course, identify before the order block, must be close in proximity, like Trevor said, to be considered an IDM and valid order block. And then, of course, generally this will come to your main leg extreme refinement, right? Make sure to have these points down, written down, and then we're going to cover the key takeaways of all inducements. All right. Now the key takeaways for the inducements, right? Again, remember, inducement, liquidity as a whole, but inducement tells us where price has been, where price is going, and how it will get there, as you're about to see in the next few slides. Inducement tells us where price has been. If we see this, we know this is where price has already been, right? It's already induced, trapped to the buy side, and now we're reversing. Where price is going, let's say you are looking at this. I'll just say I gotta shift this example a little bit. Based off of this scenario right here, where is price going at this moment in time? If this is where price has already been, where's the immediate place that it's going? Boom, right? It just needs to go down here. It's either here, here. And based off of this, the different scenarios are here to higher, or what? Lower and then higher. Only one or the other. So we know where it's been, we know where it's going. And the last thing is how it will get there. This is taking your level of understanding of inducement to the next level, which we're going to be doing today. You have this right here. In order to break this low, what do we need to do? We need to collect more gas to then break a low. This will repeat on a fractal level. You've already collected the main gas to get here, but price is never just going to go all the way down. You're always going to have some individual pullbacks and retracements. So you can expect how it's going to get there is going to be an internal roadmap that we have yet to talk about, which is going to be discussed today. Again, inducement is always needed prior for an order block mitigation. If you do not have an inducement and you just see an order block right here and you see price just selling all the way down, don't expect this to work at all, right? If it does work and you don't see a type 2 over here, if you don't see this over here, let's say this would validate that, but you don't see that, what does this tell you why this worked? What's another inducement type that you would need to look for if there's not a type 2 and your main range still worked? What's another inducement type that would tell you this is valid? Type 3. So our type 3 is going to be to the left. And that's how you can know this will work. But if there's absolutely none, it will not work at all. And we'll see plenty of examples of that. Again, inducement is our confirmation and for identifying the correct order block. Without inducement, you're not identifying the correct order block. Also, it is our confirmation for entry. Inducement is always our confirmation for entry. Now, we have not talked about entries, but the reason inducement is our confirmation is because it validates where the stop losses are, or tells us where the stop losses are, which ultimately verifies our order block, so that we can expect a quick liquidation of these stop losses and then for price to reverse. And that's why we always get these sniper entries, always ensuring liquidity is taken before that drastic reversal. Last but not least, inducement is only the last immediate structural point. Even with some current students, I've noticed that sometimes a lot of individuals will confuse inducement when it comes to structure. We'll have people, we'll see some examples that will say, you have this. And then let's say this ends up being the right order block here. Let me see. Let's say that this ends up being the right order block here. And then we have individuals who will say, this is the inducement. Is this an inducement right here? Anybody? Is this an inducement? Even if you don't know, take your best bet. No, this is not an inducement because this is structure that already happened. So where is the inducement then? Inducement only relates to relevant structure. This is our range right here. We're only going to have two inducements. Where's the internal inducement then that validated this order block? Right here. Because this is that immediate low, lower high, lower low. Inducement is only the most recent structural points. If it's happened in the past, it's not an inducement because it's already moved on, right? So this is the inducement. And yes, this is a type 2 inducement. Yes, sir. This is a type 2 because we're buying below a low, anticipating a lower low, right? So that's what I'm saying. Before even going on the charts, I want you guys to master these diagrams. Just master, boom, 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 boom. Once you can master the diagrams, everything is going to be so much easier because when we walk through and I show you my exact approach, you're going to be like type 1, type 2, type 3, type 1, type 2, type 3. You're going to be flawless. But if you start applying these concepts without even memorizing the diagrams, it's going to completely turn your learning process or your learning curve from this, when I walk you through it, to possibly even regressing because you're not going to be able to apply it the right way consistently. XYZ. All right. So glad we were able to go through all of this. All right. We do have a break coming up for everyone who's asking. So now that it's starting to make sense a little bit, right? We know the different inducement types, or at least conceptually can understand what's going on. The big question, how will we use inducement going forward? How will we use inducement going forward? Again, barely scraping the surface about inducements. Understanding inducements alone can make SMC highly profitable, but we are not SMC, we are not inducement, we are not trap, we are algo type traders, right? We're algo type traders. So it's time for us to learn today about that. So day 2, right? Blocked 1. Mastering inducements, IDM cycle, and SMC traps, aka SMTs. So in this section, everybody, you guys can expect to learn the different types, strengths, and classifications of all inducements, not type 1, type 2, type 3, different. You're going to be able to master smart money traps, and this is where things are really, really, really going to pick up very, very quickly, and you might get confused. Do not worry. And that's why it's important to master the inducement types, because it tells you where the SMTs are. You're gonna be able to master the inducement cycle. And then the last step's preparing you for the algo origins, which is in block 2. We got a lot to cover today. All right, so advanced inducement 201, inducement strengths and classification. Learn the strengths of inducement to determine the potential reaction. All right. Let's see. We're going to go through this slide, and then I will give you guys, what time is it? 10, 12. All right, we're going to go through this slide and maybe the next, and then I'll give you guys a 15-minute break. It'll be the lunch break, and we'll come back. All right, type of 1 if that sounds good to everybody. All right, sweet. Get right through it. One thing that we need to understand, we're a long time ago, price doesn't know time and time doesn't know price. If you've heard of that before, what does that mean? On a chart, we know that we have the x-axis is always going to be time, the y-axis is always going to be price. Meaning they do not know one another. When it is 2:53 a.m., price doesn't know that it's 2:53 a.m. But what happens is time and price, even though they don't know one another individually, they work together collaboratively. So when it is specific times at specific places, specific things will happen. Only then, right? The strength of an inducement specifically is related to the amount of time that it has spent on the chart. So when we're talking about inducements, we're talking about type 1, type 2, type 3 as a whole, right? The longer your inducement, the larger the inducement, the longer your inducement is on the chart, you can imagine the more gas or the more money is going to be lying below it. So the larger the move, we can anticipate afterwards. Case in point. If we're on a monthly chart, right? The GU, for example, which looks, this was GU. This is our monthly chart. Where is our monthly inducement? We have a low, or lower high, lower low. This didn't make one. This was our lower low. This monthly inducement has been laying on the charts for 20 plus years. So we need to think about it. There's a ton of liquidity below here because the time frame that the inducement is on is directly related to the amount of gas or money that is lying below it. The larger the inducement, the larger the move we can anticipate afterwards. So as soon as this inducement was taken out on the monthly time frame for GU specifically, there are a ton of pending orders below here for years, decades. Once GU breaks this level, I'm going to be putting my life savings in there, whatever. Some people are crazy, right? That's what they're thinking. So we need to know that the larger the move, no matter what type of inducement it is, the larger it is on the larger time frame it's actually there, and the longer it's spent on the charts, the larger the move. So what happened, for instance, on GU is the inducement was collected, and then almost immediately, a day or 2 days after, continued and proceeded 500-600 pips immediately after, even though those two things that's required for price to go anywhere, order block strong enough to take price there and enough liquidity before the order block to cause the gas to go to that destination. GU did not mitigate an order block. Now we don't have any reference to the left because it's already made these all-time lows, right? So now it just took a strong enough, enough liquidity to go higher. With that being said, the strength of inducement, again, related to the time frame that it's on. And we're about to understand, we can go through that the next slide. So specifically, though, what do they tell us? What do they tell us? How large of a reaction to expect after it's taken out. For instance, you can imagine that a 1-minute inducement will cause a smaller reaction than a 1-hour inducement. You can expect many more pips to be happened or to be, collected, targeted afterwards. It also tells us how much gas has been collected. If we are either just topping off the tank for just putting in the extra fuel to then get to our destination, if we're already in cells, right? If we're already in cells, maybe this is some 1 minute right here. Are we just topping it off a little bit then to go lower? Or have we already made the main fuel up and are we ready to go the other direction? So the strength of inducement tells us one of those two things. Are we either continuing to do a minor fuel up to go to our destination, or have we already now reached our destination and are we ready to major fuel up at the major gas station to then reverse price the other direction? Let me know if anyone needs me to repeat that. This is very, very important. After we learn about this, the next most important thing, please repeat. The strength of inducement tells us two things. One, if we are just going to do a quick fuel up internally, if we're going to do a quick fuel up to top off the tank to get to our destination is R1, and R2 is if price has already reached our destination, if price has already reached, right, those monthly lows, and we've already reached our destination, then it tells you that we are now fueling up the entire tank so we are on empty, and now we can expect a huge move in the opposite direction. So after we can go through that, yep, you're welcome. Arguably, the next most important thing is we will know where the inducement targeted is based on this. Again, I'm drawing this out, even though we're about to go through a few things, because conceptually, it's very important to understand. If we've already taken out, right, if you've already collected our destination, you will be able to know where price needs to go after a major fuel up. You'll know where price needs to go after a major fuel up. And then that's all that you focus on is in here. Compared to if you are just doing a top off on your tank, if you're just topping it off, getting barely, where are we going? We're then still going to our destination because we're just doing a quick top off to get to our destination. So wherever the strength of your inducement occurs, that tells you where price needs to go. You guys will be learning how to trade from trap to trap, aka structural break to structural break, based on a specific series of inducement strengths to other inducement strengths. All right. So I'm going to give you guys 10 more seconds, and I'm going to go to the next slide. All right, let's get right to it. Advanced inducements, strengths classifications. The strength of inducement relates to the amount of time, price spent on the chart, and the time frame it's on. Three types of strengths. As Antoine said, we have major inducements is the first one. Major inducements are every solid liquidity zone on the higher time frame. Liquidity zones meaning everything that we've already talked about. when it comes to the liquidity types, where a high liquidity zone is, that is where all of the higher time frame liquidity zones are. If it's equal highs, if it's trend lines, whatever. And when we talk about major inducements, it relates to specifically the 4-hour, daily, weekly, monthly, so on and so forth. Pretty much everything above the 4-hour is what I would consider a major inducement. This is every structural point present more than a week. This is also inclusive of previous weekly highs and lows. Previous weekly highs and lows. This is also every multiple inducement on the 4-hour time frame. These specifically, right, are key. So major inducements, in the past, I would always categorize them with the color red, because as we get into the different strengths, oftentimes students will forget about the strengths, but it's arguably one of the most important factors, because you're going to be learning how to trade from different inducement strengths to different ones. So I would make a note, you want to color coordinate your inducements based on the strength that they appear on the charts. So I would typically use red for my major inducements, which tells me, all right, big warning, after this is taken, you can expect a big reversal the opposite direction. So these are our major inducements. Our medium inducements are all of our intraday liquidity points, liquidity structure or intraday structure. It's every solid liquidity zone on an intraday time frame. The time frames that this is relevant on, right, is the 15-minute, 30, 45-minute, 1 hour, and one of my personal favorite time frames, which not many people use, is the 2-hour. I love the 2-hour time frame. So the 15-minute, 30, 45, that's one of my favorite time frames too. The 1 hour and the 2-hour. So is that all the solid high liquidity zones on all intraday time frames? This is the previous daily highs and lows, PDH, PDLs. These are oftentimes liquidity points. Not all the time, but they can be, and you'll know when they will be. These also are session opens, highs, and lows. Are our medium inducements. So, so London high, London low, Asia high, Asia low, New York high, New York low. All of these are liquidity points for intraday traders. Then, of course, Asia high and Asia low, ... to be continued next weekend. Keep going, guys. I know we're getting a little long-winded here. Once we get this, you guys will have a nice break, and then we will come back for the fun block 2. Really, really fun stuff. So keep going. We're almost done. You have your major, your medium. I'll use like a blue or a purple for medium. And then, of course, our last one is going to be our intraday. Our intraday, or our minor inducements. I'm like erasing stuff as I'm talking. Yeah. The minor inducements. These are all of our intraday and our entry internal points. All of our entry and internal points. These occur on the 1 minute all the way to the 15-minute. 1, 3, 5, 10, 15. I use the 1 minute, 2 minute, 3, 4, 5, everything to the 5 minute I use, and then I just use afterwards the 10 and the 15-minute time frame. So this is every intraday internal point. So within our main range on intraday, right? If this is our intraday range, let's say this is our intraday higher low, higher high. This is going to be our scalp or internal points of our intraday time frame. So just like here, there is a type 3. There we go higher. And those who stayed after Zoom yesterday, we know what type of setup this is. This is, and one of my personal favorites, right? So this is every high and low for a consolidated or of a consolidated market of every individual candle. And this is where you're going to be learning today that inducement isn't just present in structure, but above every high and every low of every individual candle. So everyone type a 1 in the chat once you are complete and good with this page. All right, great. I'm going to take a poll. Do we want to have a break now or go over an example from a diagram perspective of how to trade from trap to trap? Break or yes, sir. All right. Figured. I keep going. All right, guys. We are going to take a 17-minute break. So at 11:57 my time EST, please be back here and we're going to start. So get lunch, go to the bathroom, let your dogs out, breathe, and we'll be back here in 17 minutes on the dot. All right, everyone. Excited for the next block. And timer starting now. You guys are free to leave. Ziggy, set a time for 17 minutes.
Soon, as soon as everyone else comes back. For those of you who are here, particularly the new students, what do you think so far?
Everyone said they're ready to continue, and we're going to pick right off where we left off. Antoine and Kareem, can you guys let me know if everyone is ready and if we need another minute or so? Remove the people that are not ready.
We need about 1 more minute. I'm going to start placing people in the waiting room and then get started.
Yep, just give me the signal then.
2, 1.
Let's do a quick practice. All right, everyone. So we just left off was talking about the strengths classification of inducements, right? We just went through all of the major, minor, and medium inducements. Now that we understand that, we're going to do a quick practice conceptual example of the different types of inducements and their strengths, and really starting to have you guys see what it's like to trade from a trap to trap perspective. Because we, as I keep saying, we don't want to focus on trading structure directly. We want to focus on trading the traps. So let's view a quick example that's pre-set up, right? So here, what I'm trying to emphasize, right? We have our major, minor, and medium inducements, which are all derived from major, minor, and medium structural points. You have to be able to perfectly map out internal, external, counter trend, all these different types of structure, which you'll be able to practice along the course in order to know the true inducements. And the reason this is because when you understand the different structural ranges, you're then able to efficiently apply inducement, but more importantly, know which structural range is being targeted or the inducement that's being targeted. So just for a quick example, we have 3 ranges going on here. We have our major, we have our medium, which is blue. We then have our minor. So I'm going to walk you guys through this step by step, and I'm just going to show you guys exactly how we can utilize inducement to start to prepare for this trap to trap trading, so to say, right? So what you guys are going to be able to do is first things first. What is the bias of our major structure? Well, we see that we have a high, a higher low, and a higher high. So our structural bias for major, we are bullish. For our minor, or for our medium inducement rather, what is the structural bias for our medium inducement, which is the blue, right? For our medium inducement, or for our medium structure rather, we are talking about having a bullish, but now it is bearish, right? So here we're looking at a potentially, bearish structure. For the minor, right? What are we looking at for minor? Low, lower, high, lower, low. We're also looking at bearish for our minor. We do not want to think about structure as, oh, we're buying here, selling here, buying here. We need to think about what is the main time frame, what is the main structural direction of the major inducement. So here, where are the major inducement points that we are looking at? We're looking at this low all the way over here, and we're looking at this high. Always start identifying your major inducement. So we know structurally for the major, we're bullish. Inducement wise, we know that one of two things can happen, right? When we're looking at any range, the range will either be broken and then it'll go through it, or it will be respected to then make a new high. At this point in time, we're going to assume that the range is going to remain intact. It's going to stay bullish, and there's a few key reasons why. Here, we always know we're going to have an extreme at every high or low within a bullish range, even in a major, minor, medium inducement. So this is our range right here. But what's going to validate this range for us to tell us that this is a valid order block? It's going to be based on the medium and the minor inducements. So which one of these three, the medium or the minor, one of these two, validates this as an order block? Which inducement validates the weekly order block to be true? Does anyone know, the minor or the medium inducement? Right, the medium inducement. The medium inducement validates our weekly order block, or the higher time frame order block. So this validates this order block. So we still want to be looking to buy. And now that we've identified our order block, the next thing that we need to do is identify how exactly is price going to move here. So now that we have our projection, we know that this weekly order block is most likely going to hold. We're bullish. We know that this is going to become a new target. We need to start thinking about strengths. So the medium, the minor, the major inducements are going to be the destinations. So the major inducements, since we are bullish, this is going to be the major destination. How is it going to get there? To target a major destination, you need to collect medium and minor liquidity to get to a major destination. And there are some notes, I believe, on a few videos that students put, as I had to Zoom with them a few weeks ago about this. So current students, if you guys remember where I said, to target major, you have to do medium, minor. If you guys remember something along those lines that I was emphasizing, that's exactly what we're trying to convey here. If you're targeting a major inducement, you always need, at the minimum, to collect a medium inducement to get there. You always need to collect a medium inducement to get there. So right here, we see that we have our medium inducement. In order to target a new major high, you always need to collect at the minimum a medium inducement. You always need to collect here. So to target this, you always need to collect a medium. After a medium inducement is collected, as you can see, it was rated right here. When a medium inducement is rated, swept, trapped, whatever terminology you want to use, what must happen afterwards is it needs to collect a minor inducement. It needs to collect a minor inducement. So what we're doing, it's not, here's an extreme, here's a higher low, here's a higher high. You were thinking about this as, all right, we know that here we have our major. In order for us to get to a major, we have to, 1, collect a medium. After we collect a medium, we know that we are going to be going to an order block. 2, after we collect a medium inducement and mitigate an order block, we know that 3, we then at least need to go to a minor inducement because we now collected enough gas to go to a minor. So now that we have 3 for a minor, we know that this is where price is going to go. But it could do something like this before it gets there. After we go to a minor inducement, you then have to either A, target another minor inducement to collect more gas, or you need to collect a medium to then go to a major. There's a whole, I'm gonna see if I can, I don't want to spend too much time typing this out because I know it'll all come together for everyone. But let's just say if you're targeting a major, you always need to collect medium at the minimum. If you are targeting a minor, you need to collect either a minor or a medium. And to collect a medium, you always need to collect any 3 of them. You can collect another medium, another major, or a minor. Essentially, the inducement that you're targeting, you need a specific strength from a previous inducement to target there. So if you want to target a major inducement, you must collect a medium or another major. If you want to collect a medium inducement, you must collect some form of minor, medium, or major to get there. If you want to target a medium inducement, you have to have all 3. If you want to target a minor inducement, such as here, you either need to collect a medium to target a minor, or you need to collect another minor to target a minor. The way this is presented could be a little bit confusing. I understand that, but as long as you have like rules, how to target each inducement from minor, major, medium, right next to it, what is needed to target each inducement. Typo 1 if you are somewhat following. Great. So now without explaining it, you need to think about we are trading structural break, order block, to then a new structural break, order block. So you're taking buys below to target up here. Then you're going to be taking shorts to another structural break, another order block, to then another structural break, then to another structure, then to the main structure. We are literally just trading these structural breaks, looking for order blocks above or below them. Keeping it simple right now. We'll go much more in depth with this in examples on day 3, but just know your major, minor, medium, minor structure, inducement points. You got to know them to know exactly which inducement price is going to. If you collect a minor, you can't go to a major. So on, cover later. But I just wanted to bring this to light real quickly for everybody. All right, let me just do more break slide. Awesome. All right, so now we are going to go in to understanding the inducement cycle, validating POIs, and the cycle price delivers based on efficiency. All right. What is the inducement cycle? I'm sure many of you guys have heard of it before. If you haven't, then this is your first time. The inducement cycle tells us how price delivers into our points of interest, building liquidity on both sides of the market, and repeating this cycle of always inducing, collecting, and reversing. Oftentimes what occurs is the trend line is going to be built in one direction, inducing traders to follow the trend until the main trap occurs, and then it's going to reverse price. So if you are constantly like, oh, here's my higher low, and I'm following structure, then you end up on the wrong side of the trade or trend, which I know that's happened to everybody at some point. This is the reason why, because you are the liquidity. You are not following the true narrative. You're following the narrative they want you to follow. This is the process that occurs that results in routinely inducing traders into the wrong side of the market, especially just before session opens and news. Now, personally, I love news. I love news. I love it. I love session opens, but specifically news, FOMC, CPI, any interest rates, anything that comes out, I love trading it. The only thing I hate about it is the spreads that occur when it happens. News, though, has the same impact as a session open, which you're going to be learning about, right? So the same things are always occurring. There's just external events that are going to be taking place that are going to push price where it needs to go much faster than it would normally occur. And in that process, the inducement cycle is always going to be present. So it's always going to be the same thing every day, every event, whatnot. So why do we use it? We use it to specifically verify order blocks in conjunction with understanding how price is delivering into the correct order block, making traders think that it's not going to work or that it's on the wrong trend. the inducement factor that we've learned is very important, but it's still by itself, you're not gonna be able to do too much with it. We need to take your understanding of inducement to the next level. And this is even another confluence that you can have, but there's still a much greater picture that we're trying to paint. So it's going to confirm delivery on the daily cycle scenarios that you're going to be learning about, which will be on day 3, but you're going to be exposed to a couple today, for example. Any inducement on a lower time frame will be the trigger for higher time frame expansions. Make sure to write that down. There's always a trigger. There's no such thing as randomness. If price just decides to randomly sell off, well, before this sell happens, you better believe it either took out some form of structural point, or it did what? Maintain the current structure, had an inducement beforehand, and then sold. So an inducement is always going to be the trigger. Like here is the aim, and then there's the trigger. As soon as it's taken out into the order block, that's what's triggering these expansions. So any lower high, any higher low that you see in the market always occurs as a result of a previous inducement. Why did this higher low occur? Maybe like that. Or maybe it was, I can't draw this scenario. Maybe it was a type 2. All of those things are going to happen. That's going to cause any movement on the higher time frame expansion, right? So by knowing that, we're able to trade both pro trend and counter trend scenarios because we're aligning our trades with the directional bias of the major liquidity areas and the traps. And we've all heard the trend is your friend until it ends, but all traders who hear that don't know when a trend ends until it's actually over, because you're going to be getting trapped in, oh, well, here's an uptrend. Oh, this is where the trend is over. Now it's broken a new trend. And then guess what? They just get screwed on the wrong side of the market. So we need to understand how this is all playing into a much bigger picture that's occurring. All right, everyone, if you're done type 1, and we're going to go get right into it. All right, guys, so the inducement cycle, let's review it. So there's 3 phases. The inducement cycle tells us how price is delivering into the inducement. That's going to validate our order blocks and tell us the intentions of the traders who are getting trapped in the wrong trend. So the first phase of the cycle is what we consider the buildup to the inducement. So what happens, and you're going to see in the slide that we're about to show you after we go through the rest, is the buildup comes in the form generally of a channel. It's going to be luring traders into one direction based on structure, based on trend lines, and that's where traders are going to be looking to take their positions from, right? So if all traders are viewing, oh, we have structure that looks like this, what's everyone seeing, right? They're going to be saying, oh, we're looking for buys because of a trend line. But what they're failing to understand is that this buildup is occurring so the inducement and the trap can take place. So for instance, we could be dealing with this. We could be building up over here. And the buildup is just letting all smart money traders, all retail traders focus on the trend that seems to be, dominant at this point in time. Well, the buildup is occurring for the purpose of building liquidity for both buyers and sellers on the market to create the trap. The trap is what occurs after the buildup, and the buildup is what is literally building up, building in one direction. Your buildup builds up towards your inducement right here. So you're going to see all this going back and forth. And by the time your inducement, which is right here, is taken by your buildup, it's taken, this is what we consider the trap. The trap is what liquidates the inducement, because at that point, the inducement is inducing traders to believe that once this point is broken, they're going to think, oh, now we're looking for no buys, whatever it might be. But the trap is the point that takes out the inducement, because now they're officially believing, oh, now we're looking for buys. So this is the trap. So that is this right here. If you know that you have a type 2 inducement right here, we know this is going to be the buildup because we're building liquidity to where the inducement, the trap happens that takes out the inducement, which leads us to the third phase of the cycle, which is the mitigation and the reversal. So after you get this trap, what's always going to happen is you're going to have some form of order block that is left unmitigated. And this is where price is going to mitigate to the left and then cause price to reverse the other direction. So at initial glance, this is the inducement cycle, but we need to take a deeper look. So type a 1 in the chat if you are ready to continue. All right. Our buildup. Why the hell? Frustrating. Anyways, buildup. These are some classifications of our buildup, right? So buildup characteristics. What will happen during the buildup? Price will start to bounce back and forth within a range. And this is building liquidity. It's just a standard trend line, channel, flag, pennant, whatever you want to call it. It's just luring traders into one specific direction. It's literally building up towards the inducement. That is just the most important point to know right here. If you had to know anything, these 2 points right here. When you're building up, we're just now classifying where these buildup ranges are, but it's literally building towards the inducement. So if I were to ask everyone right now, if you had this, where is the buildup and where is the inducement? You guys want to annotate right here. Beautiful, right? Keep it like that. We're building up towards the inducement. Good. Just make sure we're all clear on that, right? Normally comes in the form of after price moves from a structural point, right? So after you create some form of structure, like we create a lower high, it'll create all of that structure, internal structure, to then be liquidated in the future, right? But even more importantly, this will typically happen right before the opening of our main trading sessions to prepare for the inducement at the right time. This is a special point because we'll be talking about this on day 3 when it comes to the different sessions, how to approach them, the different setups, cycles, everything for the sessions. But just, again, very important, write this out, say refer to the build up for session openings. Right, awesome. Okay, just different examples to the right. Let's clear all this. Awesome. So the next phase is that trap, right? The trap. So what the trap is the point that takes out the inducement. This point takes out the inducement, right? We're looking to buy. If we're in right here, if this is our trend, lower high, lower low, where is our inducement? We know the inducement is going to be above this high because this is a type 1. So if this is the inducement, that we're building up to, the buildup is going to be all of the internal. So you have your inducement, you have the buildup that's trapping traders in the wrong direction. Where a trader's now looking for their order block. Oh, it's right here because this is a higher low that made a new high. Guess what? There's no liquidity. There's no inducement before this order block. So it's just going to absolutely fail. So that's how we need to view every range. Whenever you see an inducement, and it's present in absolutely every trading range. So this happens after the buildup phase occurs, and it happens during specific hours of the day for news releases, for session opens, session closes, kill zones. There's a bunch of different times it can take place. On an intraday basis, though, this creates the major trap of the day. So if you've ever heard the term creating the trap of the day or the major or main trap, that all it's referring to is the inducement that is getting liquidated. That's that false BOS, right? It's just an inducement that's collected to induce traders into the wrong direction. And then you simply look to trade away from the trap. Trade away from the trap. If you're looking at something like this, and this is your inducement, and this is your trap, where are we going to be looking to trade if this is our inducement and this is our trap? Where are we going to be trading now after the inducement, right? Yes, TJ, yes, Sean, right? Trade away from the trap. So after the inducement is collected, you trade away from the trap. Let's practice on with that. Sometimes we will have a double inducement. If an order block is here, and let's say we already had a quick mitigation of it to go lower, is this order block now invalid because it was already mitigated? It is not invalid. Why? Because what can happen is price can just come all the way back up, decide to utilize the first mitigation as another inducement to then reverse. You're going to see this oftentimes. So, students asking, when do I break even? Do I break even after the first BOS or whatnot? You can, but I'm very trustful with my analysis and how I approach things. I won't break even unless I know for a fact the price returns it's wrong. Whenever I see this, I know that a low can get taken, price can come back to take out the high, and then it will go reverse. I don't have a problem taking any loss because I generally only take trades that I'm very confident with. And at the same time, we have to understand, if you break even and the trade ends up going in the right direction, where did you mess up on your analysis? You didn't. Your analysis was never invalidated. So there's always a reason for it to come back to it. So just be mindful that a double inducement is when price has already mitigated your order block and it can come actually deeper inside of it to a potential refinement than for the main move to happen. And the purpose of this is to generate more liquidity to generate a larger move. Because also think about it, when you get in on that first mitigation and you get stopped out, that's money back into the marketplace, back to the institutions. That's more money that they now have to actually create the move, even though it's still in the same order block to the left, right? So that's why I personally, I'm always aware of double inducements, knowing that they can always take place. If your trap aligns with the daily and weekly cycle scenarios, we can anticipate this to create the main high or low of the week. And you guys will be learning more on this next weekend. And remember, the larger the inducement, the larger the move. Institutions are taking money from all types of traders, right? The larger the inducement, the larger the move. Specifically, the inducements we can anticipate the largest moves happen from are going to be those major inducements. Craig, does that make sense? Yeah, this B inducement, the inducement is the, this B induced, this is the inducement. The trap is what takes out the inducement. So the inducement is the point that is pending to be broken. The trap is what takes out the inducement because we trade away from the trap. So yeah, this inducement should go over here. Even here, right? You can think about it like this. Here's a low, high, higher low, higher high. Where is the inducement here? Where are traders going to be induced into the wrong direction from this scenario? Well, the inducement is here, right? Because if this is broken, they're going to be looking to taking a trade in the opposite direction for potentially sells. So if this is the inducement right here, the trap is the point that takes out the inducement that we look to trade away from. So the inducement is the pending point that needs to be broken. The trap is where it actually takes out the inducement and we trade away from it. All right. Okay, so I think we should all be good on that. Another example, right, is over here. We're looking in this scenario. The inducement is the PDL. That is the inducement. After the inducement is taken, this is the trap. And the trap is what collects the inducement. And then after the inducement is liquidated, we then trade away from the trap. Right? So take out a high, take out a low, then price continues to then take out a new high. Even over here, if this is your inducement, this is the trap, where's the buildup? Buildup is all over here. So it's always going to be the same on every signal. And that's, yeah, if you think about it the other way around, that's, I mean, as long as you know what it means, then that's all that matters, I guess. I know that people say exactly as you're referencing, oh, well, this point is the trap, this is the inducement, and then it works. At the end of the day, it's the same thing, it's just a different way that, people see it from their perspective, right? But this is just how I see it, keeps it simple for myself. But yeah, guys, inducement, trap, reverse. All right, and then I think we have one more example if I'm not wrong on this one, right? Then over here as well, same thing. We have the inducement and the trap, induce, and then trap, and then reverse, right? We build up to the inducement, trap, and then reverse from here. And this is where you all will be able to understand how not to just take this first trade, but then how to enter here, 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 here. Is this my edge? I'm not even gonna talk about that yet anyways. All right, let's go to the final to see the mitigation phase, right? The mitigation is, oh no, this is continuing inducement rather. So any of the inducement types that will cause structure to break, that was just a typo. All right, so the mitigation is the last point. The mitigation is just the extreme or decisional order block that is structurally supported and cause the inducement to take out liquidity into it. Again, the only order block that we know, everybody, what's the only order block that we know must get mitigated? What's the only order block we know that must get mitigated? The largest order block is the only one we know needs to get mitigated. The higher time frame, the one that is the largest, that is the only one. Any other refinements, extreme decisional, none of that needs to happen. The only one is that largest order block, okay? So price should be mitigating an order block, which makes sense on the higher time frame. The order block we are monitoring for the mitigation must have all 4 core features. Again, this is case sensitive with one of the specific decisionals, which you guys will learn a part of the course. For those who do know, it's a type 3 decisional that does not require liquidity, any of that, but everything else does. Major mitigations will always happen inside really same specific windows of the day. Now, always is never a term. So rather, we should say majority of the time will happen inside of the same windows, that being, the specific sessions, specific timings, even some kill zones, some new things that everyone will be learning. And then the mitigation must be validated by directional bias, right? So if I ask everyone, B, what type of inducement is this? What type of inducement is B? Let's not confuse the computer. I don't want to confuse you guys. Let's get rid of that because this was actually something else, not B. I know some people know what that is. But let's say the inducement is right here. This is our order block. Low, high, lower, low. What type of inducement is B now? 2. This is now type 2, right? So we sell above an internal high to then reverse. And this is our perfection that we love to always see. Great. All right. Why is this not? All right, so now we're going to go through the next part, and we're going to be talking about a quick example of this, right? I'm going to hide some of these, we'll go through together. All right, so in this example, what do we see? What are we seeing specifically? Well, we always want to think about liquidity, think about potential structure, whatnot, right? So always starting from the left to the right, we see potentially, based on structure, that we have some form of high, low, lower high, lower low, new high. Maybe indicates now that we're somewhat bullish. Now we have a high, your low, and now we have a higher high. Why did this occur over here? Well, we had to take out some gas, but that main order block was not mitigated. What price did then is this created the inducement, right? This created the inducement before our main order block below. After the inducement was created, and we know that this is the inducement that's going to create the trap, then we're going to focus only on the internal trend. So what happens is the inducement is the order block that misses, or the inducement is the wick or the failed mitigation that where price stops before the main order block. Just think about that. That's the inducement. That's inducing early buyers, early sellers, right? So right here, and then we have a trend line that occurs all the way down. As soon as this happens, we know this is our buildup, our phase A. Our buildup builds up towards our B inducement, right? Our B inducement, or AKA B, the trap. After the trap liquidates the inducement, we then have the final C, which is for the mitigation. And after we have the C for the mitigation, we then expect the reversal. And based on this, where do we think we can anticipate price to go? Well, for thinking about relevance, if we're on a 1 hour, this is going to be probably what type of strength inducement do we think this is if it's the 1 hour? Medicine, right? Medium. This is going to be a medium inducement. So after medium inducement is liquidated, we now know where would be the first 2 targets that we would look for based on inducement. Based on inducement, after this is mitigated, where are the next 2 structural highs that we should be looking to target? Minor and minor, medium, minor, major. But yeah, so think about it. Right here, this is our range from low, right here to here. The first place we should always be looking to target is that next minor. So where's the next minor? Here you go. We know this is where price must come back to. Liquidates immediately. Awesome. If this is that first place, if this is the first minor, then where's the first major? Bingo. Easy, right? That's all you got to do. Where's the first minor? Where's the first major? It'll take practice, but you guys have all absolutely nailed it. So guess what? You already know your TPs. TP1, TP2. That's it. Because once you take out here, we know that price can continue lower. But more likely than not, like we talked about, after a minor is collected, that's up, yeah, once a minor inducement is collected, which again right here, and then we see price go higher, then what needs to happen? Another minor, collecting more gas for us to then target another minor. We're just building all this minor inducement to target our main structural point. So we have to introduce them one by one because while after the learning curve is over, it becomes a little bit easier over time. There's a lot to always consider. So we're always going to be thinking about inducement strengths, trading the strength to another strength, strength to another strength, and so on. Search for more gas, right? Awesome. All right. So let's see here. No, I'm not going to have that yet. All right. All right, so now finally, we are going to be getting in. I'm going to skip this quick break, and we're going to get right into advanced inducement 201 still, smart money traps. Now, this is going to be the first exposure you're going to have, but starting next week, Saturday, is where you're going to apply them from an algorithmic standpoint, because we're about to go into a lot of meat and bones today. All right, so smart money traps. What are they, and why do they occur? Smart money traps, which we consider SMT, right, induce SMC traders in the wrong direction of the trade, and they appear to be structurally supported order blocks that are not correct. They are not correct. They're not order blocks just lying at liquidity, which everyone appears to think. They're not. Those are just order blocks that have no relevance. Smart money traps are the structurally supported order blocks that appear to be right when they are completely wrong. So all SMC prioritizes is structure and order blocks for the majority. And in order to stop out SMC, institutions induce SMC traders into the wrong direction and create an order block where SMC will identify it to exactly lose. So a case in point, as you guys are going to be seeing in the next couple slides, if traders, SMC traders are viewing this, where immediately are they looking for their order block? Be looking for an order block over here, or a breaker block, Quasimodo, whatever, who cares, right? They're going to look for an order block that is structurally supported. So when it comes down here, like, oh my gosh, I'm going to make all this money, I'm going to do so great. And then what happens? They end up failing. If this has happened to you, why do you think this has happened? Well, it's based all on this guy, inducement. So how do we approach them? Where price has been, where price is going, and how we'll get there is a key factor to identifying the correct order blocks, specifically the correct SMTs, which we use counter to regular traders. SMTs appear to be structurally supported. However, they always occur on the wrong side of the true market intention. SMTs are the result after an inducement trap to the true side of the market. Whenever you hear of SMTs, the first word that needs to come to your head is inducement. If I say, where's the SMT? Think about inducement. Where's the inducement? Because it tells you everything. So SMTs, expect a small reaction, if any, from SMT and focus on the internal trend. This is something we're going to be disclosing heavily today, next weekend. So please make sure to write this down. This is so important. And once you write that down, I'm going to tell you guys something rather important. Traders who ping pong, they ping pong on based off of SMCs. They're willing to put their money on a smart money trap in ping pong, not knowing if it's going to hold or if it's going to lose. The truth of the matter, this is where ping pong traders trade, take their positions, majority of which have a negative trading record, portfolio, whatever you want to say, whether it's financially or win rate, it's negative. I mean, I have never once seen statements from a person who ping pongs who has actually made money. Never. I mean, that's just the hard truth. If you follow people who ping pong, you're going to constantly see them blow their accounts, over leverage, always be on the wrong side of the market and be trapped. I mean, that's just how it goes because they're literally using order blocks that have no relevance in the overall scheme of things rather than a small pullback. So if they know, oh, well, maybe this is an SMT and I want to try buying here, and maybe they're already in sells here and they want to make it look all pretty, all price needs to do is either just break right through or it could just give a little reaction and then fail. So there, you really want to ping pong this when you can just deal with, I know we're going to have a pullback, then just focus on the sells. I mean, yeah, exactly. So just some pretty insight. All right, so let's get right into it. So we have two different types of SMCs, smart money traps, two different types of SMCs. This is what we consider reversal traps. I'm going to let you guys draw these down and then type a one once you are finished with this. I'm going to heat up my coffee and I'll be right back. So everyone write this down and I'll be right back. So now that we know what SMTs are, or we have at least a diagram of it, let's see exactly how we can approach these. So these are reversal traps, and these are our type 1 reversal traps. All right, our type 1 reversal traps. SMC traders are induced into seeing reversal structure. So what this means is we know that based on this, we know that after the inducement is collected, we know the SMT is going to appear in a buy side scenario. Because after the inducement is taken, SMC is seeing what? They're seeing sells. So when they are viewing this from a sell perspective, oh, here's my BOS right here. Where's the order block that they're looking at? They're looking right here for their supply. So what happens is I have drawn several times this exact scenario. Oh, here's my BOS and price comes up to my supply, and then it has a reaction. What's happening is it's just trying to accumulate more stop losses from those who are trying to sell here. And what's really happening is after that main order block, right, is mitigated to the left, all we do is the inducement occurs and then we're following the buys. The SMT is going to cause that pullback for then us to continue selling higher or buying higher rather. So This is what happens in SMT reversal structure, but this is what we consider a continuation trap, a continuation inducement based on a reversal. So this SMT happens when the initial high/low mitigates the incorrect higher time from OB to the left. So again, if you were to have some form of order block here, that's lying at liquidity. This is where dumb ping pongers are going to be trying to, oh, I want to take a sell here, take a sell here, I want to take a buy here, whatever. They're going to be taking sells from here, but you need to know that this over here is causing just to be mitigated, and then it's going to come down to the real order block, and this wrong and incorrect higher time from OB to the left. The whole purpose of it is to cause a pullback to then follow this, and this is what we consider order flow. This is what we consider order flow. Whenever you see an SMT get mitigated and price starts to react, you need to envision. This is one of the most important things about smart money traps. When an SMT is mitigated, follow order flow on the opposite direction, in the opposite direction. So as soon as this SMT is mitigated, follow the bearish order flow. SMT to order flow. That's a key word. Next week, we're going to be really referencing it, but just know SMT order flow. Where does SMT react from? Order flow. Embed that in your brain. Very, very, very important. Okay. So this is how we need to view it. And then how do we approach it? We use these zones to identify short pullbacks to continue the main direction trend for potential more entry opportunities or for more order blocks in the right direction. This happens all of the time, every single day. And that's how I'm able to get all of my positions or have my very high quality order blocks, because it's all moving algorithmically. So depending on the validity of the SMT, you can actually take a counter position, but it will only be in the short term. For instance, if this is like a 4-hour SMT, I would take this. I would take this if it were valid and it could cause a reaction. But let's say it were, lying at equal highs. Would I take this? No, it's not worth it to me, because more chances are it's just going to break right through. So you can take counter positions, but I would only do it on your higher time frames. If it's a 15-minute, 30-minute, I just say leave it alone. It's not worth it. But only really focus on trading one, maybe even 2 different trends a day. For me, I just focus on one directional bias for the day and I stick to it. I don't overcomplicate things. And you'll find out as you're working with smaller accounts, you think that you have to trade more. I need to trade more. I need to trade more. If you end up doing that, you're just going to end up hurting yourself more. You have to trade smarter. I have my own psychologist, performance psychologist. She always told me, starting even years ago, if you're going to do something stupid, at least do it in a smart area. Ever since that moment, if I ever decided to do something stupid and I was willing to take the risk, I always at least had the patience, and majority of the time it paid off. So make sure if you're going to do something, do it in a logical area. And the reason I said that is for SMTs, I wouldn't say they're the smartest thing to do, but if you absolutely need to have the urge to trade them, only do them in an area that's worth it. If it's only 10, 15 pips, leave it alone. It's not worth it, right? So after reacting from SMT, price returns to the internal order flow to break the SMT. After your inducement, you have your inducement. You then have your trap. Your trap will be following order flow. And then guess what? This can happen. And this is my favorite approach. Follow order flow, then price to target a new trap. And we'll be going over that here in a little while. Type of 1 if you are following, type of 2 if you're a little confused. Great. All right, move on to an example of this. So let's see here. SMC traps, this is our type 1, right? This is our type 1 trap. When we're looking at this, based on what we just talked about, we'll have this. This is our inducement, right? This is our inducement. This is our trap. This will be typically our SMC, right? So over here, we see that we have a low, a high, a higher low, and a higher high, as depicted this higher low and higher high here. If this is the inducement, the trap is here. This trap will mitigate some form of order flow, which we can clearly see order flow, order flow, order flow, order flow. Very clean, beautiful order flow, exactly like we'd see. And then after it mitigates, what do we do? Well, after it mitigates, where's the trap? The order block. Here's the SMC. After the SMC is mitigated, what do we expect? To come back to order flow. Where is the extreme order block? Boom. After the order block is mitigated, goes higher. This is the next order block. And then guess what? All this is accumulating positions after the trap to then cause the huge expansion to happen afterwards. So this is what we always love and need to see for our perfect examples, as Mr. Villafuerte said. This is my favorite. This is all that I would ever trade. Order flow traps, SMTs, beautiful. But this still is not algo trading, right? This is only putting some of the pieces together. SMTs, if you know how to apply them, smart money traps, they will change your whole perspective, because it's not just, oh, here's an order block lying at, liquidity. Oh, this is, what's an example? I don't even know. Oh, here's an order block. No, that's just a dumb order block. That's not an SMT. An SMT is a structurally supported order block. Makes traders believe it's going to work in the future. We were here, oh, we have a low, lower high, lower low. No, this is not going to work. Why? Because the inducement tells us that it's not going to work. Likewise, if you're looking for sells, right, and you see, even over here, they're really, everything's already mitigated. But that's a perfect example. So does everyone see how we can actually apply this in a really perfect scenario, picture perfect? All right, great. Now we're going to go into the second type of SMT. There's two types of SMTs, which are based on the different types of inducements, right? So these are what we consider continuation traps. Continuation traps, right? In this scenario, it's different because this is one of my favorite confirmations when you don't have a BOS. You are all the time going to be seeing stuff like this, and you won't see a BOS. And I'll explain here in just a minute. This SMT happens when the initial high or low mitigates the correct higher time frame order block to the left. So compared to the first example, that was a reversal-based trap for SMC. This is a continuation from our perspective, right? Or from their perspective. A reversal, remember the previous one, we were talking about how when structure is broken, this is the SMT to then continue structure, right? This is the first scenario. In this scenario, structure actually is going to be maintained. But the difference between the first and second is the first type of trap does not mitigate the true order block. It mitigates the wrong order block, so that trap ends up failing. This trap ends up failing, but it's because it mitigated the correct order block. So when the correct order block is mitigated here, and let's say that you have this, and the correct order block is mitigated, SMC traders, SMTs, they're induced into seeing buys, right? Because a higher low, higher high, here's my buys. Where are they looking for their order block? They're looking right down here. Oh, here's my perfect demand order block. This is exactly where I'm going to expect price to go higher. I love this SMT more than anything. This is how I catch my entries. This is how I catch scale-ins, POIs, intraday, everything. Because when you know the right order block, when you know the direction of the trend, this guy will always, always, always be here. Always, or at least some way you can find him. And how we use it is once you enter for that first position, maybe, we're not even talking about entry, but once you figure out that that's the right order block, when price comes down to this SMT and you know that it's not going to make new highs, how do we use SMTs against smart money traders? We simply use them for a pullback that we're not trading off of. We use them for a pullback to come to our right order block. And then we follow the institutional intent and just destroy and collect their orders like, banks do, big money, institutions, whatnot. So this is how we focus. We go for the inducement. If this is the inducement, this is the trap. After the trap, we then have the SMT. And then we have the order flow. So we have the 1, the 2, 3, 4, and then of course 5 is going to be anticipation of new. So this is what I've done throughout my extensive, rigorous engineering over the past 3 years, 3.5 years now. This is what I consider the trap and then the stack. The stack is following order flow internally, where after the trap, you then are just going to be order flow here, order flow here. This will become another area for price to come up to before just absolutely destroying. So this is what I consider my favorite setup of all. All right. So how do we approach this, right? How do we approach this? We use SMTs again to identify short pullbacks to continue in the new direction. SMC traders, another key point about this, SMC. Oh, here's my order block. Okay, it was mitigated. Now I'm going to wait for my BOS to then enter. You will all the time see, by the time you wait for this BOS to happen, the move is already gone. So what we use is this SMT actually tells us that based on this setup, we're correct. All it's going to do is cause a small pullback where we can confidently sell from our real order block to go lower. Because again, by the time this move happens, it's going to be too late. So BOS you can use for confirmation for entry, but when you become very confident with this new skill set and ability that you're going to be learning, that's going to be the least efficient way to actually enter. So even though there's no BOS, still our confirmation, as long as there's internal inducement beforehand, again, you will always see some form of inducement, which fractally ends up being the same type of trap. Depending on the validity of the SMT, you can take a counter position, but again, it will only be short term. I don't do that. There's no need to. I mean, when you guys start working and then you get funded, you realize you only need to take one position, 2, 3 a week. I mean, there's no rush to do that. But where you're going to overtrade is when you're working with very, very small capital. And I would encourage to find the roadmap that's going to allow you to trade more and trade less often. And that's what the whole other plan after the boot camp, right? So after entering the SMT, price will typically come back to order flow. If it doesn't come back to order flow, what will happen is it can actually just come back to, let's say this is where your order flow was right here, and maybe you had an order block right here. What can happen is price can just come back to maybe the extreme, and then it can go lower, right? So it's either going to come back to order flow or an internal extreme order block. All right, and then last thing over here. In this scenario, low, lower, high, lower, low. We know the correct order block has been mitigated. After it's mitigated, we know this is the SMT. After we know this is the wrong SMT, we then use this as a pullback to enter the right order block, which again, is still following order flow. And then we're going to be looking to then target simply new highs on every fractal level. Every minor, this is your minor high. You know that your medium high is going to be over here, right? And then you know your major high is going to be, over here as it's going to combine everything, just fractally speaking. All right, good. I think we're all good on this, right? Cool. So now what I'm going to do is we are going to go through one example of this, and then we're going to take a quick break. Hold on, I'm trying to see where why did this not? It's frustrating. All right, so here, for instance, let's look over here. Structurally, we have a high, low, lower high, lower low, right? Now over here, right, this is our main structure, but within we have always internal structure too, right? So this could be a little bit more complex of a scenario where we have high, low, lower high, lower low, lower high, and then lower low on, right, a fractal level. Then of course, then here you're gonna have all that. But the reason I identified this as the SMT is because everything above, there was no imbalance. And this is within our internal leg. So when our internal leg is here and we see that we have clearly our SMT right here, what happens is because we already took out this main inducement, right? This is that main inducement, and this is the trap. Where is the SMT? The SMT is going to be the order block that's left unmitigated, which we clearly see is here. After the SMT is left unmitigated, where does it come back to? Well, we can clearly see we have some form of fractal order flow going on over here. There's no imbalance. The first area of imbalance is right here, right? And this again was not on the 15-minute. This was a 10-minute time frame order block, a little different. But that's the last area of imbalance right here, right here. And then price comes all the way back to it because everything else is left efficient, no imbalance besides here, comes back to order flow. And then guess what it does? Order flow, release to target where? The new inducement. So this helps you really start to understand after you have an inducement, you're always going to be building up towards your inducement, which creates your trap. After the trap, you then follow order flow to then target a new trap. So it goes inducement, trap, order flow, new trap. And this is how every move everywhere will work. Trap, order flow, trap, trap, order flow, trap. And then I'll rinse and repeat again and again and again. But again, just a quick insight on this. All right, let's see. All right, guys. So what we're going to do now is we're going to take a 6-minute break, and then we are going to prepare for one of the last sections of today. So six minutes. Be right back, and then we're going to wrap up today. All right. All right, everyone, we're going to go ahead and get started with the last segment of today. So go ahead and return to your seat, and we will get started here momentarily. All right, let's get right to it. Okay. All right, share my screen with you guys. Come on, I'm seriously freezing. Oh, okay, sweet. All right, so we should be ready to roll. Or not. Share. Okay, awesome. Perfect. All right, everybody. So in this section, guys, we have now covered everything. Before finally we can get into the algo, right? So, oh, shoot, let me resume this, pause that. All right, so pretty extensive block 1, and for block 2 is going to be combining blocks 2 and 3 into a very very squeezed fit, because we already went through in block 1 some of the things that we're covering in block 2 and block 3, but getting right to it because there's 119 and I said by 2, so we got 40 minutes. I gotta share my screen. All right, everyone. So you guys have now learned the conceptual fundamental analytical comprehension of inducements and the inducement cycle, how inducement provides fuel to the markets. You've now learned the 2 SMC traps. And now it's time for you to see how retail traders trade versus the perspective of algo, right? So now we're going to start going into the fundamentals of algo trading, what it is, how it came across, why we use it, and again, just what it is, right? What it is. So let's get right into it, everyone. All right. So day 2, algo origins, right? So in this section, you guys can expect to learn, this is from last boot camp, the origins of the algo, how it controls all financial markets, the 4 pillars of the algo, and the prelim mastery of the algo that you guys will be learning today to prepare you for next weekend, which that is where all of the chart time, everything, because you're going to have the whole foundation laid out for you, but we have to understand what everything is conceptually from an initial application standpoint before we can even go to that level. So the ghost of the machine, the entity that affects every financial market. So what is the algo? Well, before we understand what the algo is, we need to understand what an algorithm is. And by definition, it is a finite sequence of instructions and processes in order to get a desired outcome. And those who are computer science understand, anything IT related, algorithms are everywhere. You can make an algorithm for anything that exists. For me, years ago, the first 2 years of my trading journey, all it would be putting together are EAs that would trade based off of a sequential series of inputs that would always dictate, a specified output that would be, that would correlate to the algorithm that was, trying to be made. So that's just what a basic definition point of an algorithm is. So there are endless algorithms out there based on specific rule sets for all man-made strategies, but we are interested in primarily understanding how trading like the banks and why that's been such a now way overused term in lingo. So naturally, our end goal is to mirror and understand the process of price movement flawlessly that the interbank price algorithm develops, creates, monitors every single day. And no, not IPDA, nothing ICT, but asking yourself, since the inception of the electronic markets in 1971, that's not new. These have been around for decades. How is price endlessly auctioning up and matched to willingly participate with extreme precision? What actually allows any of us, for that matter, to enter and execute trades whenever we wish? It's not like we're in the stock market and we have to wait for someone to sell their position before we're able to buy it, or vice versa. You're going to have a buyer before you can sell your position. You are literally able to enter and exit virtually whenever you want to, minus sometimes the lag in execution speed from brokers. We try to close your position. Obviously, there's other matters at hand, because we need to understand that no human is controlling or monitoring price. No one is. It's all automated by algorithms, and only a program governed by a select group has that capability, that unconscious automatic processing down to the decasecond. Not only is it not emotional, but it's all based off of specific rules, all based on liquidity, right? Now, the picture you see in the background, that is something we do not have access to. It is indicative of an order book. Order books to see where all of the liquidity lies within the market. Bookmap is a good place that you can reference. I've never used Bookmap, but I've always been interested in understanding how specifically the amount of orders, the amount of liquidity, the major liquidity, the minor liquidity, all the different types of inducements that you've learned. The reason that we're able to assess their strength is because of the logic that they have on a price chart, right? On a chart, because the longer it's there, the more orders that are below it. However, because we do not have access to these order books or these liquidity providers, and we can't see the exact amount of orders that are in the market and exactly where they are, we have to use our best inference, because at the end of the day, we have the same information in front of us in the form of candlesticks that the institutions, big banks, liquidity providers, everyone has in front of them, but just from a number standpoint. They see all the numbers, the contracts, the deviations, they see everything, right? But what actually makes a candlestick that we look at is all those numbers on the back end, the amount of buyers, the amount of sellers, how many people are losing their positions. That's how wicks and liquidity, all these are created. So we have the same information, but it's viewed in a different way. They have the tangible numbers. We have the visual graphic representation. So that's why I always say you have to be detectives, because we need to figure out exactly what they're seeing without directly having the same information. So that is why it is the ghost in the machine, the market. It's the entity that affects every single market, and that is the algorithm. So what entity actually monitors price? The central bank, right? The central bank is the primary operator that controls and regulates monetary policy and money supply in all financial markets. Central banks influence all interest rates and participate in open market operations to control the cost of borrowing and lending throughout an economy. At the end of the day, if you are very good at understanding economics, micro, macroeconomics, what are you going to be studying? What are you going to be looking at your entire life when you're studying economics? You're going to be a data analyst majority of the time. You're going to look at correlations. You're going to look at deviations. You're going to look at all the numbers. That is what we need to understand. That is what's really driving the market, is understanding the controlling, the regulating, how everything is being influenced. And the central banks is the entity that's doing that. Specifically, the cost of borrowing and lending, which we refer to as transactional liquidity. Now, we know what imbalances are, but why is it so important that imbalances need to be filled, or that liquidity needs to be balanced? Because of transactional fairness and distribution. There always needs to be equalness or fair market opportunities for both buyers and sellers. If there wasn't, that would indicate just flatlining charts, or just vertical charts make absolutely no sense. There's always opportunity for buyers and sellers. And the reason why we have the pillars of the algorithm is so we know exactly how everything is distributed equally and fairly in the markets, always giving an opportunity to buyers and sellers, always taking out sellers for each buyer that comes into the marketplace. So we're going to see that specifically here in just a moment. In essence, everybody, the central bank algo is what drives the market, right? Is what drives the market. The algo is based on transactional liquidity and has been in place since 1971 through the pioneering work of Gordon Macklin. I'll definitely reference and recommend everybody look up who Gordon Macklin is, read about him, do all the research you can, because I'm not doing that right now. It is able to understand the exchange between buyers and sellers through over-the-counter functions. This transaction exchange is necessary for every move in the market from a micro to a macro perspective. An SL, buy or sell, always needs to be collected in order to go anywhere. Whether it's 1 pip, whether it's 1 pipette, there always needs to be the conversion from buyers to sellers, because that fluctuation, that balancing of taking out a seller before a buyer and rinsing and repeating this process is always going to ensure there's some form of fairness. More importantly, some form of fuel that's going to allow one party to take over temporarily, and then in the future, allowing the other party to come back into the marketplace and take out the first party who it was unequally distributed to make it fair. So understanding that as rigged as the market is, there is regulation within manipulation. And that's what no one talks about. The markets are manipulated 100%, but they need to be manipulated. So that provides people, institutions, retail, anyone at any point in time, it's going to give everyone a fair opportunity to win once in a while, win here, win there, at least give them the opportunity to do so. But there is regulation within that manipulation. We are not interested in specifically where the market is manipulated, as that's what you guys have already been taught and what you guys have gone through. We are interested in exactly how the manipulation is regulated. That is what we're interested in. So how is it regulated? How is it distributed fairly? How is there always going to be intact buyers and intact sellers for every clean buyer and for every clean seller? Well, let's dive right into it. Shoot. Right? Taking the red pill, escaping all restrictions and seeing the future. We need to understand that money is a tool. As much as it is an illusion, you just like trading, you have to think outside of the box. You have to think that all of this, there's no such thing as randomness in the markets, in life. Everything happens for a reason. Absolutely everything. And it's only up to you to elevate to a higher level of consciousness to understand that there's always a point in everything. But if you're limited to the limiting beliefs that you've always believed, you're never going to be able to see from the outside of what is capable, what is true. And that is my goal, to show you guys what trading can actually provide for you. But you have to escape all the restrictions and limiting belief that are going to allow you to do so. So by understanding specifically the money exchange between 2 or more different operating ranges, meaning main, internal, two different trends, 2 different ranges, you are able to predict and use our advantage to understand every push and pullback on every level of the market, on every time frame from the highest to the lowest. And the liquidity cycle is what balances the markets and delivers the algo every single day. That's the checks and balances of the algorithm. That is what's regulating the manipulation that occurs in all financial markets. If this happens, then this must happen afterwards. Or if this happens, I know now this needs to happen. It's all not just the manipulation, but the regulation and how the market is delivered. So understanding this foundation and learning how to accurately ping pong if you choose to do so, but my edge specifically, you're going to learn how to trade on any side of the market, for any buys, any sells, but most importantly, where to get in and when to get out the most effectively every single time. Every single time you're going to be able to understand this. Oh shoot, did I lose everyone? No, you guys are still there. My screen's tweaking. But you're going to understand all of this, okay? It's going to take some practice, but you are going to get it. So the hardest part is that learning curve. Now, what I'm hoping over the next several weeks is you guys will be able to transition to viewing this entirely by itself and on its own. Let's get right into it. The 4 pillars of the algo, right? The 4 pillars. The first one is inducement. Inducement. We've conceptually talked about the algo and how it is regulated, but now it's time for you to see the different pillars and how it actually makes everything regulated. So inducements is the first pillar of the algo. By understanding that structural points, when they get broken, this equals SLs for multiple types of traders. You then understand that the algo is continuously building and inducing SLs on fractal timeframes, not just right here, but you have traders who are losing right here. You have traders who are losing right here. You have traders who are losing literally everywhere all in between, but that's after we go through the algo. So understanding that for every buy stop loss that happens, an immediate sell stop loss needs to happen after that, and vice versa. The algo must always return internally to take out a higher low or lower high after taking out a higher low. Very, very, very key point right here. So what I mean by this, if you see this happen and you see a high taken out, you need to know immediately that within this current range, fractally speaking, as soon as this high is taken, we have stop losses rated, right? Where's the immediate place that the opposite side of the trend is going to have stop losses? Right here, if we have sell stop losses rated, now we need to rate buy stop losses. The first area within this range where buy stop losses are going to occur is right here. We need to know as soon as this gets collected, the first internal point is where price must always come back to. Must always come back to. This is what always needs to happen. So inducement to inducement, 2 to 3, 2 to 3. This is just the first stage of a never-ending cycle for the algo. So what I'm saying right here, you have this, right? You have a high, new high. The first higher low internally must get taken out. Where is it? This is the only higher low. So this must get rated, and price will not stop until it gets here. Even down in this example, whenever you have a high that is taken out, you always need to know that first higher low within your range will always become your liquidity point. So price must come down to here ASAP. First area, but this is just the first part. These are two rules that must always happen. Whenever you take out a high, whenever you take out a low, that first internal point, price must always come back to. Due to fractality, the algo starts on the lower time frame inducement points to target the higher time frame inducements. Remember how I said lower time frame inducement is the expansion for a higher time frame, or is the trigger for a higher time frame expansion? Remember that. You're going to make sense of it here in just a minute. But this is how you need to start viewing the market from range within range from a liquidity standpoint, not structure, but liquidity. All right. So type of 1 if we're ready to continue on. Let's get 10 more people and we'll continue. All right. The second pillar. The second pillar that I have discovered myself when it comes to a specific point that we refer to as the transactional point of the algorithm is called engineered liquidity, abbreviation ENG LQD. LQD. ENG LQD. What is it? Engineered liquidity is the internal, one specific internal liquidity point within a range that mitigated nothing and leaves the first imbalance behind. Someone writes it down. I will continue lower. Ten seconds. The sole purpose was to create a short-term move that'll end up being taken out before the real move. Purpose was to create a short move for the real move to take it out. This point must be taken out before going external of a range. And just make sure to make note of the specific diction: internal, external. It's the internal liquidity point that must be taken out before going external of a range. Oftentimes, it occurs after the inducement, but it can also be the inducement. This is referred to as the transactional point of the algo. All right. For the algo to balance transactions between buyers and sellers to create a fair market, it needs to take out both traders in both directions before continuing anywhere. These are all important points to write down. As soon as they're written down, I'm going to hide the above. All right. Now let's look above. So what is engineered liquidity? Engineered liquidity is the first internal liquidity point that creates an external range. So when we are looking at it from this perspective here, or looking from here, what you're going to see is when you are looking at a main range from a high, higher low to a higher high, this is what you consider the external point of your range. What happens, though, is within your range, you're oftentimes going to have this. Price will just come down, run away, and then it will start developing some form of order flow, and then it will continue higher. This first internal point, this right here, will not mitigate anything. Also, there is an imbalance that is left behind here to here. This is what we call the transactional point of the algorithm, because this is the first internal liquidity point that causes structure, right, to be broken. So what happens is after we take out an inducement, price should come back to here. And any order block along the way, just give small pullbacks for this to be liquidated, because this is where the buyers first got in. Sellers are taken out. Here, they're stop losses. Buys take over. And then what happens to balance the transaction between buyers and sellers, the cost of borrowing and lending, we need to come back here to balance this. Now we have to take out the buyers that funded this move internally. So we take out sellers, we take out buyers. Now algorithm is back to homeostasis. Now it's time to restart the cycle again. So now price will then continue to go higher. And of course, it'll be rinsing and repeating this whole process all the time, right? But that's what needs to happen. So looking at this example, where's our main range? We see that we have a low. We then have what? We have our main push. Within here, we see that we have a push, and then price, continues higher. What I'm illustrating though is this over here. Do you see how this just swept liquidity? It swept it, but an order block was not mitigated, just mitigated an imbalance. When this point occurs, it will either mitigate nothing. It'll just sweep liquidity to engineer a quick move that becomes liquidity in the future, or it'll mitigate a higher time frame order block to keep going. One of the two is going to happen, but regardless, the point remains the same. It needs to be liquidated. So when you see this happen over here, after price liquidates and creates the next bullish push to happen, this is the point that price must come back to. So what happens is after you identify this internal liquidity point, price will then have to come back to liquidate it, and your imbalance with your order block will be mitigated. Again, over here, you'd be taking out some form sellers, right? And then you're going to take out buyers. And then now it's time for you to take out sellers again. So now where's the next place where buyers need to get taken out? Right here, because this is where they first happened. So now we know it needs to come back down here. But we have a lot of practice to go through. So let's fly through this. Same thing over here, right? What happens? We see over here, we have a low, high, higher low, higher high. This is our external range, right? This is our external range. After our external range is created, where's the first internal liquidity point that doesn't mitigate anything and causes the bullish push to happen afterwards? We see it's right here. This did not mitigate anything to the left. Order flow started establishing mitigation after it. So that tells us this whole move is unsupported. Even though it goes up, it's buying, it's short term. After we collect gas, that's only then that's going to allow us to come back down, taking out again sellers to come back here, to take out buyers, to mitigate our order block, right? To mitigate our order block. After it's mitigated, we then know price will come to take out sellers and rinse and repeat, sellers to buyers, all over the place. But you're going to have a much easier representation of what this is when we get to the anatomy of the algo next week. All right, let's keep going forward. Let's skip this. All right, let's take a quick look at an example. So first thing we need to ask ourselves, where is the inducement? What is the structural point that is pending that needs to be broken? Here we have a high, higher low, higher high. I'm only saying structure so you know where the inducement is. We sell above previous higher highs, which tells us a type 2, right? There's a type 2 inducement right there. After the inducement is taken, you need to shift your eyes. Inducement's taken, where's my engineer liquidity? Your engineer liquidity is that first point that always occurs after that major first imbalance. Where's the first major imbalance? We see that it's all right here. Yes, you have this, don't worry about that. Your point of engineered liquidity is not one candle. It has to create order flow or some mitigation afterwards. So over here, does this mitigate anything to the left? No, and don't you dare say, oh, this is a breaker block. It's liquidity. It's don't say that. But afterwards, after it doesn't mitigate anything, what happens? Price will then start to establish order flow. Low comes back to mitigate the order block that that swept no liquidity, engineered liquidity itself to keep going higher. So what happens is after the fact, price then starts building, right, up towards your inducement. After your inducement is collected, boom, where's the next liquidity point to focus on? Your engineered liquidity. That's what needs to come down. Taking out sellers, taking out buyers. Based off of this, then, we even talk what we've been doing so far. You have your inducement, then have your trap. After your trap, what do you focus on? Everyone type in the chat. After the trap, what do you focus on? And we're almost done, y'all. Keep you guys going. Order flow, great. There's a trap, and now you focus on this guy over here. Order flow, order flow, order flow, order flow. Oops, swap liquidity and mitigate this. Order flow, price goes lower. This is not mitigated. This is, now we have new order flow. Order flow, order flow, order flow, order flow, order flow. And I know you guys can't see that at this point, but all of these entries possible. Again, I'm not saying you guys take these, please don't, but this is what you'll be learning how to do. After you take out all of the order flow, guess what? Engineered liquidity. Engineered liquidity. This is what we also call a wall. Engineered liquidity is called a wall. That means this is where price must come back down to no matter what. This is our wall. And this is where it needs to be rebalanced. So that allows you, after the trap, after the inducement, all you do is focus on this internal trend because it has to take out this wall. You're just going to follow the order flow to take out the wall. And again, we must come back to the engineered liquidity. It's a transactional point. It creates the first, or it happens after that first imbalance. Oftentimes, it'll either mitigate this higher time frame order block, which, by the way, that's what a breaker block is. It's just the top of a higher time frame order block. But the lower time frame remains unmitigated. Last but not least, it could mitigate nothing, but regardless, it needs to get taken out. So after it gets taken, then what happens? Well, price will mitigate some form of order block. After it's mitigated, then the whole cycle repeats. Guess what? If this is your engineered liquidity and your true mitigation happens, this is your trap. Now what do we do? Order flow, price releases. But you're going to learn if there's no imbalance with that wall, that makes price be all the way expansive until we come back to some form of imbalance to the left. So you're going to be learning about all of this. So now if I had to ask here within now our new high and our new low and our new high, where's the engineered liquidity within this range? Some struggle. I see both ways, right? Now, what we need to think about, I don't know if I should say this for next week, right? But we need to think about that this right here, this swept, didn't mitigate anything. This did not mitigate anything, right? So in this point, you actually have two potential areas of engineered liquidity, but this is where the algo comes into place that you'll be learning about. One is an inducement and one is engineered liquidity. This right here, right? This would actually be the engineered liquidity because this happens after that first major imbalance. This is called something else. Within here, you have high, low, high, low, high. What is this? There you go, Ahmed. Yes, sir. This is a type 3. This price has to take this out. So it can actually mitigate this and then go higher. There's a lot we're going to be putting together, and you guys have yet to see the anatomy of the algo, which combines both of these concepts and more. So let's finish up the last couple, and then we are going to end today. You guys will also be receiving homework for this week. All right, and here we go. Finally, the third pillar, order flow. Institutional order flow is what shows us where the institutions are accumulating their positions after the main trap. It is the consecutive mitigation of extreme order blocks and will happen on lower time frames to accumulate the positions before taking off drastically. Okay. These are the highest probability setups after the inducement and the trap, and engineered liquidity taken to target a new inducement in the counter direction. So let's actually view this. These are diagrams which you guys the opportunity to receive after the boot camp. And let's see. So if we're just looking at this one example, everybody, where is the inducement in this example? If this is the main order block right here, where's the inducement? Everyone only identify the inducement. More than 2 people. Only the inducement. I know you got some smarty pants in here, but only the inducement now. Come on. Yes, Trevor. Yes. The inducement, everybody, is right here. This is the inducement, specifically a type 2. After the inducement is taken, where's the trap? Everyone just label T, mark it, just so we can keep moving forward. Okay, bueno. All right, love it, love it. Good. There we have the trap. So then this is the trap. After the trap, where is the next trap we should be targeting? Beautiful. And how is price going to get to this trap? Order flow, right? Order flow. And there we go, right? That's all it's going to do is use order flow to get there. So if that's the next trap, which we're targeting, because this is an inducement, well, then all we're going to do is follow the order flow to get there. And after order flow, again, oftentimes you're going to learn something called decisional order flow. If it always came back to the extreme, it would just be building liquidity, right? So then you need to expect an impulse afterwards. After 3 to 4 mitigations, then you're going to see, all right, well, here's our new decisional. Now it's just going to create a new order flow after that. Oh, then it's come down here, and then it's just going to keep going all the way exponential. So this is how you always need to view your ranges, from order flow, from trap, from inducement, trap, mitigation, order flow, targeting a new trap. And this is how orders are accumulated from an institutional perspective, not just randomly staying points everywhere, but even within here, you're always going to have minor inducements. And these minor inducements are what's going to allow you to target a medium. This medium inducement could potentially allow you to then target a major if you're bearish. You're going to learn how to navigate it flawlessly. So as per Trevor's request, we are going to look back at some of these key points and then go on to the last few slides. All right, total spin. See, no. Does anyone still need this? All right, great. You're almost done, everybody. Same thing over here. Everyone mark out only the inducement. Where's the inducement if this is our sell order block? Everyone, inducement, inducement, inducement. So first step, mark out the inducement. And I would draw these. I would draw these. If this is your inducement right here, where is your trap? Beautiful. This is your inducement. This is going to be your trap, because your trap mitigates your order block. Let's now think about 3. The third thing is what? Order flow. Now, if I had to ask everybody, where is the SMT? The smart money trap. Beautiful, beautiful, beautiful. I love it. I love to see it. This is now our SMT, which this is going to be 3. Four is our SMT. Order flow. And then, of course, as soon as SMT is mitigated, comes back to our order flow. And then after 4, SMT to order flow, 5, then of course is just going to be a new trap. So go ahead and label your charts like this, because any inducement, it doesn't matter if it looks like this, if it looks like this, it's always going to be the same pattern. Here's my inducement. Here's my trap. I know my inducement is here, and this is my trap. I know my SMT is here. So that tells me if this is the right order block over here, I can now just focus on the internal order flow, because none of this is going to work. It doesn't matter what you do, but if you know what traps are, if you can master those diagrams for inducements, you then know where the traps are. If you know where the traps are, the SMT traps, you then know how order flow is going to be respected. And then it's just going to rinse and repeat the entire time, over and over and over again. Because after this is taken, guess what happens? Oh, this is the inducement. This is the trap. Guess what's going to happen, ladies and gentlemen? It's just going to repeat the entire thing over and over and over again. That's how we need to see everything. Trap, inducement, trap, order flow, the whole 9. So how's everyone feeling so far, just about the conceptual application? 1 for great, 2 for stellar, 3 for I'm not feeling good at all. Great. Awesome, everybody. I love to see it. As long as you know it conceptually, the chart work is the easy part over time. Awesome. Now let's go to the last 2 slides, and we're going to start with of course, yeah, you need to practice. Of course, this is just the origins. We got plenty more. Don't worry about it. All right. Talking mushrooms. All right, and last thing, we're going to go over this pretty quick. This is another picture perfect example. After, let's see, this is your structure. Low, high, low. If this is your inducement here, we know the trap happens after the inducement, right? After the inducement is taken by the trap, what then do we follow, right? We follow order flow. So with the anticipation that this is going to be a potential type 1 bullish inducement, right? Because after we collect the inducement, we take out the low, we look to then reverse and target over here. So until we get to this point, we're just going to be following order flow. We have inducement, the trap that'll mitigate some higher time frame order block to the left, and then we just follow order flow. This extreme doesn't mitigate. That's fine. The decisional is mitigated, however. And we know this is a decisional. It's a type 3 specifically. Those who don't know what I'm talking about, you will after the boot camp. Where's our engineered liquidity within here? Well, this is where the price first picks up and then rallies off. Where's the engineered liquidity over here? Where's the engineered liquidity over here? There you go. Oh, crazy, get ahead of me. Whoa. Yes, you take out what? You have to take out, sell. Take out, or take out, buy. Take out, sell. Take out, buy. Order block. After you take out a buy, what do you need to do? Take out a sell. After you take out a sell, what do we need to do? We now have this pending, and we also have this, right? Because this is still following order flow. After decisional is mitigated, the extreme that mitigates the decisional needs to be mitigated. So then what happens after the fact? It needs to come all the way back to here, right? It needs to come all the way back to here. After we have this mitigated, where's the engineered liquidity within this range now? After we take out buys, where is, there you go. Yep. Trevor, Luis, TJ, yes, sir. You guys all got it. That's where price needs to come, right? So then let's think about it. After that gets taken, where's the liquidity within the range? Well, it's already identified for you guys, but this is it, right? That's it. After this gets taken, what are the first next two places that should get targeted? After this low, after buys are taken, where's the next two sell areas where stop losses are? Boom, boom. You guys are even getting it before I can say it. Love it. Here, here. So now we know that price will have to probably come here, maybe come up. Does first and after. Okay, same thing. And then guess what? It'll just rinse and repeat over and over and over again. It's literally going to be the same thing all the time, right? So after we take out buys, take out sells, take out buys again, take out sells, take out buys. After buys are taken, then we have to do what? Take out sells. After sells are taken, what then do we need to come back to at some point? Well, sure, you need to come back here, but really, because this did not mitigate anything to the left, this is where we need to come back to before the main move. Also, based off trend lines, based off key zone liquidity, we know why this fails. Based off of trend lines, right? We know that trend lines have to break. And then after we take out buys, we can then take out sells. It's always balancing between buys and sells. And once you know just these 2 points, you know everything you need to know. And you're going to view ranges so easy. But what's going to allow you to see them easier is when you actually see the anatomy of the algo. And that, my friends, is for next week. All right. Let's see. And guys, the last one is just this. The fourth pillar, right, are just going to be other order blocks. It's the final component. Now, order flow and order blocks are one and the same, but order flow is the consecutive mitigation of order blocks, and order blocks themselves are just, they don't need to follow order flow. For instance, here, I mean, you guys will always see the same. Take out sells. Take out buys. Take out sells. Take out buys. Take out buys. So now what do we think? What's next? Now we need to come back to take out sells, right? We need to take out sells. So based off of this, Where's the first major imbalance? It starts, boom, this is our engineer liquidity. Now price should end up coming back up here before even thinking about selling down again, right? So it's just identifying order blocks, and still, even in this case, everybody, you'll still see it follows order flow. Have our inducement, here's our trap, here's our beautiful order flow, and then here's our target, another trap, for then to repeat. Always the same, right? So just identifying extreme decisional order blocks that are lying after your inducement or your engineered liquidity, especially with order flows. And then when a decisional is mitigated, always remember this order. Always remember this. And that's something you guys will be learning more about within the course. All right. Again, we only know the higher time frame order block must be mitigated. Remember this. Please, like, absolutely. That's so important. Do not over refine order blocks. You can make your refinements, but your refinements don't need to get mitigated. The only thing that needs to is that highest or the largest order block on your higher time frames. All right. All right, everyone. So based on that, next week we are going to be going over the remaining of the cycles, the intention and purpose, internal, external range liquidity, tying in all together the algo, mastery of the algo, all of the intraday scenarios, and you see. Awesome, guys. Yeah, guys. So I think that's where we're gonna leave it off today. I want to stay really strict with the timings because I could spend hours. Last boot camp, I think day one was 8 hours or something crazy. It was like 30 hours for the last boot camp. So now you guys will have everything on the back end. I think that's where we are going to end it off for today, everybody. And you guys will be receiving homework for this upcoming week. And I am thoroughly excited for next week. I'm excited for you guys to be a part of the community, of your journey. I'll be answering a bunch of questions this week. You guys know who are part that these bootcamp weeks are quite the workload. So I'll be getting back to you guys. So message me, and you guys will be receiving homework for this upcoming week, in addition to learning about the different tiers that you guys are going to be put in for current and new students and the requirements for all. So thank you guys. We were sweating pretty much. I couldn't say that, Angela. I know. Thank you for your time, brother. Absolutely. Thank you, guys. Thank you. I hope you guys have some key takeaways. I'm looking forward to the remainder of the bootcamp and the fun stuff, which comes after when you guys start making your plans, building and making money, getting funded, all the fun things. Things do more and more clicks. Thanks to I mean, that made sense, Trevor. Absolutely. Yeah, guys. I'm very, very happy I can help you all up to the 200K account. Yeah, man. I don't want to be president, man. Ain't political. Making money regardless who's president. You guys are welcome. Thank you guys for joining today, and I will stay tuned and catch up with you guys here in the next 24 hours. All right. Have a blessed day, everybody. I'm in YouTube, brother. Yes, homework will be given this week for you guys to practice. All right, now guys, get off your computers. Get to rest. Have a great day. I will catch up with you guys later. All right, see you guys. Thank you, guys.